Hello everyone, welcome to today's US Open live webinar. It is Thursday, May 18th, 10 minutes before Wall Street opens at our usual slot. I'm your host Nikos Zabouras, Senior Market Specialist at FXCM. We have quite a few things to talk about today. Markets continue to monitor the debt ceiling situations and they turn hopeful after the latest round of remarks. Positive news came from regional banks as well. While also in the spotlight, we have upgraded oil demand outlook by the International Energy Agency, whereas on the corporate front, Elon Musk teased 2 new Teslas during yesterday's Investor Day, while luxury fashion designer Burberry posted strong results helped by China's reopening. And these are some of the things we will be talking about. But before we do that, please read carefully through the risk warnings and the disclaimers, and then we will get started. If you could also be kind enough to type in the chat box if you can hear me properly and if you can see my screen properly. Just to confirm, you could type it in the chat box to confirm that you can see my screen and you can hear me without any issues. Okay, thank you all for confirming that you can hear me and you can see my screen. All right. Once again, please read the disclaimers carefully. And bear in mind that anything discussed does not constitute investment advice. Also, if there are any other comments, questions, your thoughts, or any questions around what we will be discussing today, feel free to type those in the comments and we can address when we have time. Okay, let's get the ball rolling. So we have Euro USD on our screen. It falls again today from a series of factors, including hawkish Fed commentary. But before we get to that, let's take a quick crack at the corporate activity we saw today. One thing that stood out for me was British high-end fashion designer Burberry, which reported strong financial today for fiscal year 2023, which ended in April. Revenues rose to more than £3 billion, helped by China's reopening. That is a strong testament to how China is doing. A theme that we have covered a lot, both on written content and through this series. And there was a 13% sales jump in mainland China last quarter. However, the stock got hammered actually, despite those positive results, as investors perhaps are cautious around China's prospects and perhaps because they focused more on the firm's poor performance in the Americas, the United States and other regions of this continent. Now, a day ahead on Wednesday, we had Elon Musk once again in the spotlight as EV King Tesla hosted its 2023 Investor Day, and he touched in quite a lot of subjects. He spoke of 2 upcoming vehicles and was likely referring to the highly anticipated affordable model, while teasing a hatchback-looking model in the back. He also provided more details on the Cybertruck, deliveries of which will begin later this year, but pushed back production of the Roadster, which into next year, which is in any case a niche model and not something that would drive significantly higher revenue and profit for the firm. In any case, the stock rose yesterday after this investor day, and in a generally good day for the US stock market. Okay, so let's leave that behind us. You can I have posted extended articles on both Burberry and Tesla. You can find those on your respective FXCM market analysis websites. Now let's move to USD. It comes from its worst week of the year and extends those gains today as the greenback benefits from a moderation in the aggressive rate cut expectations by markets. We have talked about how the ECB has clearly signaled more hikes where the Fed hinted to a pause, but we have also expressed our the fact that we're a bit cautious about whether the Fed can actually stop hiking at the next meeting, and the biggest risk for the pair is that markets may be overestimating that factor around the Fed. Inflation is elevated and far from the Fed's targets, but labor market remains tight. So they may have a hard time pausing, and we have seen hawkish commentary recently, and definitely officials have been dismissive about rate cuts. So markets have, it looks like they begin to realize that. And if we look at CME's Fed Watch tool, rate cuts have been pushed further back towards the end of the year. And also they now see a higher terminal rate compared to previous. They now project 2 rate cuts, whereas they used to price in 3 rate cuts. So all of that have benefited the US dollar this week, which benefits in risk on environment, risk of environment, everything seems to work in the favor of the greenback this week as well. So the pair now breaches test key support area. You can see here it's the daily Ichimoku cloud and the ascending trend line from the 2022 lows. And there is risk for further losses. This definitely puts the 2023 lows at 1.0481 in play. There is still the 200 period EMA, that exponential moving averages, that can withhold losses, and the truth is that the move does feel a bit stretched. But in any case, this repricing definitely creates problems for the pair and downside risk, and we would be cautious here. Now, on the other hand, as I said, it does look a bit stretched, and there are important support levels throughout this region that can support the pair and give it the chance to rebound back towards the EMA 200, the 200 period EMA, the black line that you see on the chart, at around 1.09. But again, we're cautious about the ascending prospects at this stage, and the 2023 highs at 110.96 look distant. So definitely cautious as we see this repricing in markets around the Fed. Now we're going to move over to the Aussie dollar versus the greenback, and we had a series of news and data points from Australia. Then we will talk about oil, and then about the US stock market. So let's now go to AUD USD. So we had many news, as I said, from Australia this week. On Tuesday, the Reserve Bank of Australia minutes were a bit on the dovish side, although keeping more hikes in play. Wage data on Wednesday showed an increase by 3.7% year-over-year in the first quarter, the biggest in 11 years. And the pair had a mixed reaction. On the one hand, this increase makes taming inflation hard, but the RBA does believe that it will fall, and it has been moderating inflation. And in any case, even though the wage price index was high, it doesn't seem to be high enough to justify a wage price spiral. Today, unemployment rose to 3.7%, which could allow the bank to pause again. Labor market is very tight here as well, but this shows some signs of loosening. Now, bias is clear on the downside. We have talked about it again. The pair rejected multiple times the critical 38.82% Fibonacci of the 2023 high-low drop. It trades below the 200-period EMA, the black line here. And there is a clear risk of fresh 2023 lows at 0.6563, although the next support, major support at 0.6433 still looks distant. On the other hand, maybe there is, as I said before, overreactions around the strength we see on the US dollar. So we could see efforts to bounce towards the EMA 200 period, but in any case, from that point on, the upside is unfriendly with multiple impediments, and we would definitely need to see daily close above the 200 period EMA and into the Ichimoku cloud for the downside bias to pause, perhaps. Now let's change gears and go to US oil. So the commodity left Tuesday's discouraging Chinese data behind it. We talked about them extensively, and was held by broader optimism, sparked mostly by regional banks and debt ceiling. We will talk a little bit more about that when we talk about the SPX 500. And the other highlight here was the upgraded demand outlook from the International Energy Agency. So the agency raised its 2023 demand forecast by 200,000 barrels, expecting growth of 2.2 million barrels per day, 60% of which will come by China's rebound. Very important estimates there. And these help are supportive of oil prices. They jumped on Wednesday because of that and the broader sentiment that we referenced, and they remain close to key technical levels. There is a significant region here, a significant roadblock here for US oil's advance provided by the 200-period EMA and of course the daily Ichimoku cloud. Closed above the EMA would pose downside bias, but we don't expect any fireworks from there on. Even if there are prospects for higher prices, the oil market is probably going to be a bit balanced still. As long as it does not break fresh ground and stays below this key technical area, there is increased risk for sub 70 moves. And although the 2023 lows in this highlighted region just below that look increasingly like a bottom, they are still in play. And now let's round things off with the broader SPX 500 index in the United States. We're already 4 minutes into the session. It rose yesterday on the back of optimism around the debt ceiling saga and around the state of troubled regional banks. The estimated deadline comes as early as June 1, according to Treasury Secretary Yellen. That's as early as when the government could be unable to cover all of its obligations. Comments from President Biden and House Speaker McCarthy created hopes for a successful outcome. Sentiment was also held by the fact that regional lender West Alliance Bank Corporation disclosed an increase in deposits this quarter so far. This lifted not only this bank stock, but also the broader regional banking sector, as shown on the SPDR on the SPDR regional banking sector ETF. Not much has changed since Tuesday analysis. SPX 500 defended the key 38.2% Fibonacci of its last leg up and formed a double top, which sustained the bullish momentum for 2023 highs. Wednesday's advance brought it closer to that goal, hasn't achieved that yet, and this could pave the way for further gains towards 4,326, but we're cautious at this stage around that. On the other hand, markets have moderated their rate cut bets, and despite the optimism around regional banks and the debt ceiling, we still have no resolution, and banks still remain in precarious positions. As such, there is risk for a test of the 200-period EMA, the black line here, but sub 38.2% moves will require a strong catalyst. That is it in regards to the technicals and the recent developments. Not much going on over the next few weeks. We expect Japan's April CPI inflation tomorrow. The express food reading had peaked at 4.2% year over year in January, and the highest since 1981. It decelerated significantly in February to 3.1% and stayed there in March. Yesterday, we got GDP data which showed a return to growth of 1.6% in Q1 from a 0.4 contraction in Q4, according to the revised data. Other than that, central bank commentary, mostly the Fed, and specifically Chair Powell on Friday, remain on the radar. So far, as we said, we've seen mostly hawkish comments dismissing of rate cuts. And of course, the debt ceiling always is front and center. That's it from me. Thank you for joining me. We'll talk again on Tuesday.